2030, 50% of the population could be self-employed in some way, shape, or form. Between COVID, the economy, the changing job market, we're seeing more and more individuals that are doing self-employment in some capacity. We're already up to almost 20% of the population currently that has some sort of 1099 S-Corp self-employment business, and that number is expected to rise. That could easily become 30% by next year, and again by 2030, almost 50%. Now this includes individuals who own their own business, again are in S-Corps and have ownership percentages of other businesses, or what we see a lot of is like Uber, Lyft, DoorDash, these other type of quick kind of side hustle money that comes in as a 1099. So all of self-employed individuals go, how do I buy a house then? My income looks a little weird. Thankfully, there are a lot of options for self-employed individuals. We typically call these non-QM options. They're not like your conventional loan or FHA, the normal guidelines, because we're using alternate types of income, right? We don't have a W-2, we don't have a pay stub. So a lot of them will fall into this non-QM land. The most typical way we're going to try to verify is with the taxes. We're going to look at the Schedule Cs, see from your 1099 income, did we have enough? The problem becomes with a lot of Schedule Cs, what we see is good amount of gross income, but after all the deductions come out, the net income is very low. I've seen some where it's almost 100K in gross and $5,000 in net income. So the problem with that is $5,000 in net income is what was reported to the government that individual made, technically, and that's all they're taxed on. So we on the lending side go, okay, well that's all I can typically use then, because that's all you've told someone you actually made. So 1099 alone doesn't usually cut it unless individuals are purposely filing their taxes with the intent to buy a home. If any 1099 individual, or whether again that's someone who owns a business, a realtor, DoorDash, whomever, intends to buy a home, ahead of time they need to start talking to their CPA to be able to file their taxes in a way that can show more income. Pay more in taxes, but you'll show more income. So that's one way, is just the regular 1099. Another loan option though that gets used a lot is a bank statement loan. So instead of looking at your 1099s, we're gonna look at the business bank statements. All those bank statements that come through with all of the deposits and the income, and we average them across usually a 2-year time frame. Sometimes we just use 12, especially if business has increased. We just wanna use the last 12 months. But this is one that, for example, realtors use a lot, right? Because they have income coming in from sales and purchases from homes, and it's not always going to reflect that well in the 1099, but we've got a lot of deposits coming in. So bank statement loans are a great option and can help be the workaround from the 1099. However, I tell everyone, number one, those deposits need to be clear that they are business related. If you are someone where people are Venmoing, Cash Apping, giving you cash, whatever, it needs to be very clearly documented in that transfer what it was for, or you need to have invoices that match up. Because when we start to go through those bank statements, if we just see numbers with nothing to them, we can't verify that that was actually business related and not just cash you got from selling a piece of furniture and threw into that business bank account. So the deposits have to be verifiable and be very clear that it is for the business. Now, bank statement loans and most of these non-QM loans that are using alternate types of income, they do typically come with a higher down payment. Anything that gives you access to something that you wouldn't typically have costs money, right? So they will tend to have higher down payments of 10 to 20% or more depending on debt to income ratios. But again, they have a lot more flexibility. They may also carry higher interest rates. So some individuals will utilize like a bank statement loan, keep that for a couple of years while they change the next 2 years of taxes to qualify with the taxes, and then refinance into a traditional loan. Another type we can use for self-employed borrowers, especially when things get real muddy between all the taxes and the bank statements and S-Corp this and K1 that, sometimes we use what we call P&L, or profit and loss statement loan, and that's where CPA creates the profit and loss statement for that business. So let's say we have the 2024 taxes, but 2025 is being held for most of the year before it's going to be filed. We may look instead at doing a profit and loss statement loan. That's specifically done though through a CPA. That's not something you just like create yourself through Canva. Again, typically carries a higher down payment, higher interest rate, because it's even higher of a risk of, we really hope that's what you were making to be able to qualify, but also another good backup plan. And a third way we qualify self-employed borrowers, depending on their situation, is with an asset qualification loan. This is for individuals that are doing maybe some self-employment. Maybe they have a small business that they're running on the side, but they're primarily funding themselves through larger portfolio accounts. Let's say they have a ton of IRA accounts, 401ks, all these dividend stock accounts, and their 1099 is really their side hustle. So in that case, we will typically pivot to an asset depletion or asset qualification, where we're taking the total amount of assets that they have available across a certain amount of months and years, and we're using that to show that they have income that can be set up as disbursements to pay them from month to month. So the good news is there are products available for this influx of self-employed individuals. They do need to have 2 years of this self-employment history. We have to see, was year one a fluke, or is this going to be how you run your business? Or are you ramping up? Because again, a bank statement loan is a good example where maybe I want to use your last 12 months, not the 12 months before, because your first year was tough and your second year you really ramped up business. So we have these alternate products that are really great for the self-employed individual, especially again as we see more and more people entering that arena. If you have any questions though, or want to talk about specific scenarios, let me know.